Okay, so get this. Imagine a company just drops the best earnings report of its life, and its stock immediately just nosedives. Sounds crazy, right? Well, that is exactly what happened with the chip giant Broadcom, and today we're going to figure out how on earth that's even possible.
So, let's set the scene. It's December 12, 2025. Broadcom comes out with a just phenomenal quarter. They beat everybody's expectations. We're talking record-breaking revenue, incredible growth in their AI business. I mean, it looked like a perfect report card. And then, bam, the stock just cratered.
So, what in the world went wrong here? It's a classic Wall Street mystery, you know? And to solve this thing, we gotta put on our detective hats. We have to look past those shiny glowing headlines and dig a little deeper.
All right, first things first. Let's build the case for why this stock should have absolutely skyrocketed. I mean, let's look at all the incredible stuff Broadcom reported right on the surface. First up, the revenue. We're talking a staggering $18 billion, just for the quarter. Now, this wasn't just good. It absolutely smashed what Wall Street was expecting, which was around $17.5 billion.
But here's the kicker. The real engine behind all this. It's their AI business. I mean, it grew an astonishing 74% compared to last year, hitting $6.5 billion. And let me tell you, this is the part of the business everyone has their eyes on.
And it wasn't just about the top line, the revenue. Profitability looked awesome too. Their adjusted earnings per share, it came in hot at $1.95. That easily beat the $1.89 that all the analysts were predicting.
And if that wasn't enough, they just kept dropping good news. I mean, check this out. They landed a brand new fifth custom AI chip client. They locked in a massive $11 billion follow-up order from the AI company Anthropic. And they took care of their shareholders, bumping up the dividend by 10% and extending their stock buyback program. It's just win after win after win. You even had the CEO, Hock Tan, on the record saying he's never seen demand like this before, ever. So you have to ask, right? With all this amazing news, why on earth did the stock drop? Okay, time to really start digging for clues. Okay, our first clue is a little counterintuitive. It's actually hiding inside a number that serious investors watch like a hawk, and that number is called gross margin. So what is gross margin? Well, put simply, it just tells you how profitable a company's stuff is. For every dollar they sell, how much is left over after paying for the direct costs of making that thing. A higher percentage is always better. It means more cash to cover all the other expenses and, of course, make a profit.
And this is where we find the first piece of the puzzle. You see, Broadcom's booming AI business, especially those big, custom chip deals they call system sales, well, they actually have a lower gross margin than their old-school, traditional business. And that creates this weird paradox, right? As this incredibly successful, fast-growing AI part of the company gets bigger, as it becomes a larger slice of the pie, it's actually pulling the company's overall average profitability down. So yeah, more money's coming in the door, but they're keeping a smaller percentage of each dollar as profit. And hey, don't just take my word for it. The company's own leadership confirmed it. They straight up told investors, hey, expect our overall gross margin to drop by about 1% next quarter. And the reason? Because of all these new AI sales. For Wall Street, that was a huge red flag. That's our clue number one.
Okay, let's move on to clue number 2. Now this one's a little more subtle. It's kind of hidden in plain sight, inside another massive number that on the surface sounds like great news.
So Broadcom announced they have this huge AI order backlog. We're talking over $73 billion worth of orders that they're going to deliver over the next year and a half. I mean, that sounds absolutely incredible, doesn't it?
But the really sharp analysts on Wall Street, they didn't just take that number at face value. They immediately started doing some back-of-the-napkin math.
Okay, so here's what they did. They started with that $73 billion total. Then they took out the big, flashy new orders from Anthropic and that new fifth customer. That's about $22 billion right there. So what's left? About $51 billion. And that's for their existing core clients, the Googles of the world. Now, if you spread that $51 billion over the 18 months, which is 6 quarters, you get about $8.5 billion per quarter.
Now stay with me here. Remember that $8.5 billion per quarter number? Let's compare that to what the company officially guided for AI revenue next quarter, which was $8.2 billion. See the issue? That $8.5 billion is kind of the average for the next 5 quarters after that. This implies that after this coming quarter, the insane growth from their most important customers,
well, it might slow down and go almost flat. And that was clue number 2.
So, there you have it. We've got our 2 big clues, a warning about lower profit margins and some math that hints at a potential growth slowdown. I think it's time we deliver the verdict.
And here's the thing you absolutely have to understand about Wall Street. The stock market is a forward-looking machine. It doesn't really care about what you did yesterday, no matter how amazing it was. It is completely obsessed with what you're going to do tomorrow and the day after that. It's all about future growth and future profits.
So yeah, the numbers for right now were spectacular, no doubt about it. But those 2 little clues we found, the ones pointing to maybe a little less profit per sale and maybe slightly slower growth down the road, that was enough. It was enough for Wall Street to panic and hit the sell button. Because in their world, a slightly less amazing future will always trump a fantastic present.
But look, a single day's stock drop is never the whole story. It's just a snapshot. Let's zoom out a bit and look at the bigger game Broadcom is playing here, because it's actually pretty fascinating.
See, Broadcom's whole strategy in AI is pretty clever. They're partnering up with the absolute giants. We're talking Google, Meta, companies like that, to build custom-designed AI chips. They call them XPUs. Think of them as chips that are tailor-made for one specific job, which makes them a really compelling alternative to just buying the standard off-the-shelf chips from the big kahuna, NVIDIA.
And that really leaves us with a final big question, doesn't it? The market, it panicked over these short-term signals, right? Margins, growth rates. But Broadcom, they're playing the long game. They're positioning themselves to be the go-to company for building the custom engines that power the biggest players in AI. So maybe, just maybe, the real story here isn't about one bad day for the stock. Maybe the real story is about a quiet strategy to completely reshape the entire AI hardware world. And that might be the most important takeaway of all.
Thanks so much for watching. I truly appreciate your time and support. If you found this video helpful, inspiring, or even just interesting, please give a thumbs up and drop a comment below. Your encouragement means the world and keeps me motivated to create even more exciting content around stock market insights, trading strategies, and financial growth. Don't forget to subscribe to the channel, Stock Market Wiz, and hit the bell icon so you never miss a new upload. Let's keep learning, growing, and trading smarter together.